Hi guys, welcome to a quick video where we're going to be understanding who are the main players in the stock market. This is a fundamental learning block that you must understand before you can even think or begin to become a successful trader or investor, okay? Because it is so important to understand the other main players who are trading and investing in the stock market, as well as your own, because everyone's got different strategies, but it's also very important to understand the other players' strategies. It's also important to look out. There's some things that you need to look out for from some of these um, investors, other players in the market, whether they're selling or buying their shares. So we'll get into that more in a second. So the main players: retail investors, large institutional investors, and corporate companies buying and selling their own shares. So retail investors, it's like me and you. So they're individuals. They're not professional. They're got their own savings or pension or whatever it is, and they want to invest it, and they think they trust themselves more than a financial advisor. They buy and sell shares, exchange traded funds or mutual funds. They use a broker, such as these are some online brokers: Robinhood, eToro, which is I use eToro, eTrade, Fidelity, TD Ameritrade, which these are some of them are only available in America. So they also invest with smaller amounts of money compared to large institutional investors. We'll get into that more in a second. Take up a large amount of the market volume. They take so lots of retail investors. They invest with small amounts of money, but because there's so many of them, they actually make up quite a lot of market volume, from day traders to swing traders that are always in the market trying to make daily profits off the market. They tend to be less knowledgeable, less disciplined, less skillful, and more emotional in their investing and trading. It's not 100% true all the time. I mean, some will be, some won't be, but they're not professional at the end of the day, so they are more likely to make mistakes. And there's also a range of investment strategies. Like I said, some of them are looking on a daily outlook, thinking that trade-off patterns. Some of them are value investors looking in what could Apple be worth in 5 years' time. Does Amazon have a lot of growth in the next 10 years? And they're looking a lot more long-term, whereas other traders, they just go for those high volatility companies that are in the stock market, really high volatility, and they just focus on those. Right, on to large institutional investors. So these are more companies. They are professional. They invest using large quantities of money. They mostly invest other people's money on their behalf because they're professional, they're trusted with this money, and they're investing. They're the big dogs. They have a lot of money, and they make up 75% of the volume of the New York Stock Exchange. These large institutional investors include pension funds, mutual funds, money managers, insurance companies, investment banks, hedge funds, and they can be seen to work together. I'll do a video on that soon, of how like the players that influence the market a lot, but and how we've actually seen it quite recently. But yeah, these large institutional investors, they have a large control over the stock market. So this is a fundamental player that we must understand as retail investors before we start trading. Because if large institutional investors are thinking of selling out, because we've gone into a bear market, for example, and changing their ratios from 40% bonds and 60% stocks to 60% bonds and 40% stocks. Because we're in a bear market, then we should expect a large sell-off from stocks, which means that if you're, regardless of your retail investor strategy, you're going to see a big drop off, and you can use that to your advantage to either sell out or short the market. Okay, so finally, corporate investors. Corporate investors are basically just the corporate management team who can buy and sell shares of their company. And for example, Tesla, they're going to be dishing out shares to their management team as bonuses quite often. So if you see a lower management manager sort of just selling out on some shares, then it could just be them cashing in on a bonus they've been given for the year. However, if it's a large sell, if Elon Musk, for example, sold out on 50% of his shares for Tesla, then this could be a big red flag, and this is what you need to be aware of from the corporate investors, as it can give you a pretty good outlook on where the company is going in the future, as the managers for the company are going to have a better idea of the future than us, because it could be some news that hasn't been published or been released yet. So it's a good idea to follow the corporate investors, and the way you can do that, there is a link that I'll put in the bio where you can put in search the company, you can see all the managers, and you can see how many shares they have sold or bought in each quarter. But yeah, so that concludes this video. If you've enjoyed, please do hit that like button, it really does help. Subscribe, and if you've got any questions, do leave us a comment. Thank you.